Hello, everyone. I'm Alan Siegert of Navatar. It's a beautiful day on the East Coast, and we have a great webcast today. I'm really excited. Alex Rogers of Performance Equity joins us from Greenwich. He's fresh off the road from weeks of fundraising. He's just closed 2 funds. Alex will tell us about the 4 myths of fundraising. And then our Navatar tech wizard, Ketan Kankar, is with us at our headquarters on Broad Street in New York, and he's going to show how to use technology to leverage some of the suggestions that Alex is going to make about fundraising. And then we'll take your questions. Enter those questions into the GoToWebinar panel on the right side of your screen. Now, I've got questions too, like what's going on with fundraising outside the United States. But first, Alex is going to tell us about the 4 myths. Alex?
Thank you, Alan, and thanks everybody for joining us this afternoon. Like Alan said, I want to go through just some of the kind of ideas that I'm sure as investor relations and marketing people you hear a lot, and the kind of things that we have to work against and work around and work with sometimes, and just kind of sort of lessons from the road, I suppose. The first one, myth number 1, is one that I think everybody has dealt with in one form or another, and it's unfortunately one that's not going to go away anytime soon. This idea that the presentation deck has to be perfect. And the truth is, as I say, the graph on page 24 is just fine. Leave it alone. It has to be good. You have to have high production values. The presentation has to look good. It has to have accurate information. It has to look professional. But at the end of the day, the deck is not the thing that counts. It's how you present it. It's the message that you have. It's the story that you're telling. And you have to know those things. You have to really kind of internalize the message and the story, and it does a lot of things for you. One, it makes the meetings much more interesting because you know what you're talking about, and they don't wander. The conversation doesn't wander all over the place. It also makes it a lot easier if you really know your message, if you really know how to deliver it, and you've really got that story down pat. It makes it a lot easier to talk to the person on the other side of the table from you because you're not worried about trying to remember that point 4B that you have to make sure you get out. You can just kind of run the script and pay attention to what they're doing on the other side of the table and what they're taking notes on. It really comes down to knowing who it is that you're talking to as well. You've got to know your audience. You've got to know, what the person on the other side of the table is looking for, what their problems are, what kind of concerns they have. And a lot of that is just pre-meeting research that everybody has to do. You're better off spending your time figuring out, what kind of issues a particular plan sponsor might have or what they're looking at in their portfolio, rather than spending that time making sure that the colors on the one page match up just perfectly. We have in one of our decks, and the slide stays in because it on very rare occasion becomes useful, but it's a waterfall chart that we've spent I don't know how many hours building. It gets its own footnote in the back of the book. It has it's been legal reviewed. It has 47 lines of disclaimers on it. It's a fairly ridiculous thing, and I think in 3 years I've talked to the slide twice, maybe 3 times. So it's one of those things that the amount of time that we spent on putting that slide into the deck really could have been done. It could have been used better somewhere else. So it's just one of those things. Get a deck that works, that tells you the story that you want it to, that has good pertinent information in it. But really, learn your story, learn the message, and figure out how you deliver it. I think modifications to the deck come from that experience. And then, as much as anything else, and perhaps more, know who it is that you're talking to. Know the audience so that you can change the message that you give in the meeting. If you stick strictly to the book, then you're never going to be able to modify your conversation to meet the person that's across the table from you and to figure out what it is they want to hear. So I think if there's one way to work smarter, not harder, it's don't focus quite so much on the deck. It has to be good, but it doesn't have to be a masterpiece. It has to get the point across. It has to get the message out. But it's really your delivery and your knowledge of the person on the other side of the table that counts more than anything else. So, which gets a little bit to the second myth about who the other person on the person on the other side of the table is. We hear a lot. I'm sure everyone else does that. Well, if that's not the CIO, then I don't know why we're talking to him. The fact is that, yeah, probably you'll end up talking to the CIO at some point, eventually, maybe, but it's not a certainty. And it's not always good to have the CIO be your first point of contact. I mean, CIOs are busy. They're looking at the entire portfolio. They've got to deal with the boards. They've got to deal with liquidity issues. They've got to deal with total portfolio construction and a whole host of things that aren't really investment related, and they're not spending a whole lot of time thinking about your particular fund or your product. So you really need to get into the internal team and figure out who is it that can be an advocate, who is it that makes decisions, where do you need to get in order to start telling the story and get your message across. You always have to figure out which direction pressure works better. I know in my past history, you see suggestions come in from on high, and a lot of times your action is, oh great, another brilliant idea coming down that that doesn't fit in with anything else that we're doing with this portfolio, but somebody saw somebody at a conference and decided it was a great idea. Sometimes that does work though. You've got to get an idea pushed into an organization from somewhere. Sometimes you can go from the bottom and find an analyst who you see at a conference or that you just happen to have some connection to, and you reach out to them and the idea bubbles up from there. So it's really important that you figure out the team structure and kind of the right entry point. If you focus entirely on going after a CIO or going after a particular level within an organization, you're not necessarily going to be more successful. Every organization is different. Every team has their own kind of structure and the way that they work, and so it's really important to figure out how you get in. And honestly, a lot of times keeping good notes and keeping your CRM system up to date helps with that, so you can remember who it is that you talked to the last time and what they said, and then when you get notes from the field in that somebody saw somebody else at an LP meeting or at a conference or something else, you can put all that information together to help triangulate what's the best route to success within that organization, and how do you get things moving in. It's also a good way to keep track of who the analysts are, who the consultants are, who's doing portfolio management within the group, so you can really figure out who the team is and what they're doing, and that's the key to it. You can't just go after the CIO every time. I will say that it does work on occasion to catch a CIO at a conference and put a bug in their ear. We have a large estate plan that we're working with. It's really a new relationship, somebody that we've been talking to for less than a year now. But we saw the CIO at a conference that we were at, and sent a note saying, "Hey, it's great to see you," all the normal kind of stuff that we do, and got an outbound from one of the portfolio managers saying, would be great to hear more about what you guys are doing. So we went to actually go see him because we were going to be in the area, and face-to-face is always good. And he had a completely wrong perception of what it is that we do and what kind of investments we do. And it's his understanding from the CIO was not anywhere close to what our reality was. And so it actually ended up being a great entry point because we were able to give them the wrong first impression and fix it from there, which is sometimes a good way to go. So I think the point of the myth really is to know who the team is, know what their decision-making process is, and figure out how to get in and talk to the right person. It's not always the CIO. It's not always the head of private equity. You've got to find an advocate and a champion within the organization. And that's one of those things that is it's probably one of the harder things to do, is to figure out exactly who to go after. But once you do figure out who you need to go after, you get to kind of myth number 3, and the idea that you talk to somebody and your product is so brilliant, your fund is so fits so perfectly into what they need that you should bring subdocs with you and get them to sign up at the time. Truth of the matter is, and this is one of those hard truths, you wish. It would be nice if it were that easy, but it's not. It takes a lot of time. Private equity is a long-term asset class. It's a relationship building exercise, and you really have to get in and talk to people a lot and have meaningful kind of conversations, touch points with them. There's a theory in marketing, and this is really much more towards sort of retail marketing and branding and that sort of thing, but I think it fits private equity in a lot of ways. It's the rule of 29. It's this idea that it takes 29 meaningful interactions before a consumer makes a purchase decision. I think it's exceptionally true in private equity. Nobody makes that decision on the first go round. It takes the introduction, it takes update meetings, it takes talking about the portfolio, it takes answering data requests, it takes just giving general updates on things and kind of useful email tidbits. It takes a lot of interaction to build up that relationship before somebody feels comfortable investing in your fund or with your firm. Going along with that, a lot of times the best time to fundraise is when you're not actually out raising a fund. When you're doing pre-marketing, it's even more important now, I think, than it used to be with the number of choices that people have and the amount of inflow there is and the amount of opportunities they have to invest with different groups. People still want to have that relationship. They want to know that their partner in this kind of 10-year fund is going to be good and is going to be good for them. And so you really have to keep up with everybody that you're talking to and keep up those relationships, and it becomes critical, I think, to keep good records and keep good track of who it is that you're talking to and what you've said to them and what the next step is and who it is that you're working with, which really gets to kind of that fourth myth, the whole idea that you can manage it all on a spreadsheet. You can for a while, but you really shouldn't. I think the number of people that you have to talk to now, the amount of information that's being requested, the kind of relationships that have to get built up over time, it's just too many opportunities to drop the ball and to forget something or forget someone. And really just keeping track of all that information ends up being a critical part of your job. You've got to have your meeting notes, you've got to know what kind of contacts you've had, you've got to make sure you're keeping track of any data requests or any diligence items that they've got. And you really can't afford to mess it up. There are so many options that LPs have, that investors have, and so many things that they're looking at. A lot of the times, what you're doing is just not giving them a reason to say no, because if they have to choose between 50 different options, the easiest thing to do is to find a reason to say no. And so if they can cut that field down over and over again, then eventually they get to a decision point. And so one of the things that you have to be super careful about is not giving them that opportunity or that reason to say no. You really can't afford a foot fault. Keeping track of all that information is potentially the most important thing that you can do. Just forgetting to get hold of somebody after 6 weeks gives somebody else the opportunity to talk to them. It's the other adage in marketing, right? If you're not talking to your customer, someone else is. And people will move quickly. There are a lot of us out here trying to raise funds, and it is a competition, but at the end of the day, you have to build that relationship and you have to keep track of the information that you do. I think this is certainly one area where something like Navatar comes into play. We're having a system where you can keep track of that information, where you can know what your next step is, where you can set out a plan and figure out what you're doing. It's critical these days. You've got to have it in some form, and I think we chose Navatar because it works well for us. I think one of the things that I kind of believe and work from is that you can't have technology driving the process. You have to have the process that works for you in the way that you and your team works, and then find technology that works with it. And if you can get a spreadsheet to jump through all the hoops you need, then more power to you. But I think something like a dedicated CRM system that works for private equity is an important tool and a critical item in your tool chest. I'd love to show you some of the things that we're doing with Navatar, but that's my data, and like I said, it's a competition. There's lots of us out there, and so I don't want to give up all of my secret sauce. So I'm actually going to turn it over to Caton, who is good at kind of showing off some of the bells and whistles and a lot of the very interesting things that Navatar does, and a lot of tools that we're using internally ourselves, but doing it with their data and not mine. So I'm going to turn it over to Caton for a bit and let him show you kind of the ins and outs of parts of Navatar.
Thanks, Alex. And I know today we have people from all parts of the world. So good morning, good afternoon, and good evening based on where you are. So I'll take a few minutes and just follow up on what Alex was talking about and give you just a sneak peek into some of the tools that he was referring to. And I'll focus primarily on three themes. One is to get organized, which is kind of the starting point, which is making sure that you know your next steps, you can track everything, and you're managing everything. The second, as a follow-up to that, is building intelligence about these investors. So each conversation that you're having with these investors kind of allows you to gain more insight. So building that investor kind of intelligence. And the third is kind of being strategic, which is using that intelligence to have more effective meetings, as well as targeting the right investors kind of whenever you're launching a new fund. So the first item, which is kind of being organized, obviously something kind of like the Navatar system allows you to track all your investors, and you're able to obviously manage all the discussions and meetings and kind of have all your meeting notes in one place, as well as have kind of all your follow-up action items. So if you're talking to them about the fund, all of them can be tracked in a single place. And then you can generate a report which allows you to manage and be organized about kind of who you're reaching out to, who are the investors you're in touch with, have a summary information, next steps, and be able to manage that outreach process. The benefit here is that kind of instead of doing it in Excel, you have this summary sheet, but then you also have all the backups. So all the meetings and the detailed discussions that you've had, you also have all of that in one place. Now, you may also want to kind of, for internal discussions, what we see is instead of having it like a spreadsheet format, just clicking a button within Navatar and generating like a PDF report, which gives you a quick status on kind of what your fundraising, whatever your goal was, how you're performing against that, how much commitments you have, what's in your pipeline, and kind of using this for internal discussions, identifying kind of your approaches in terms of how you're reaching out to investors, and making any changes if needed based on what you're seeing and hearing from all these different investors. And then to manage this entire process, right? So you have your spreadsheet, you have your kind of output, you have all your meeting notes, and to manage this kind of a process, something like a dashboard helps you, because this gives you a view into how overall the fundraising is going on. Not only can you look at your kind of fundraising pipeline and see kind of what's in the pipeline, but you can also track, for example, kind of by each close, how much money have you raised, and so you can kind of get down to that level. Or if you are kind of maybe in your third or fourth fund, you already have a base of LPs who have invested in previous funds, paying more attention to things like re-ups, so that you can see of all the investors that you're reaching out to for, let's say, your current fundraise, how many are existing LPs, and who are these strategic LPs that you need to be kind of paying attention to. Re-ups, kind of from what we hear and what all our customers say, it's a good indication of how solid or how deep your existing relationships with your LPs are. Right. So obviously everyone wants to get as high a re-up percentage as possible. So these are tools that allow you to manage a specific fundraise and be more organized and be able to kind of track your progress associated with that. During this process, though, what you're doing is also building intelligence about these investors. So and some of it is kind of what you're hearing from the investors. Some of it is the history that you have with the investors. For example, when you look at an investor, you should be able to see if they are an existing investor, as well as how much have they committed in your existing funds. You may be offering co-investments, and in that case, you can also track if they have co-invested in any of your portfolio companies. As you're talking to these investors, you can also build kind of intelligence about the kinds of investments they like to make. How much are they allocating? What are the types of funds that they're looking at? What are the types of strategies or industries? So you can build all this intelligence within one place. And the way this helps you is, one is being more organized and informed when you're talking to the investors. So planning for investor meetings, it becomes very easy because all I have to do is just click this button and it generates a detailed profile, kind of a two-page summary, which is all I need to prepare myself for the meeting. And it has kind of background about the investor. I can see who I'm talking to, kind of what investments they already have, my notes associated with current discussions, and also the last few conversations we've had. So something like this is very helpful in quickly reviewing where you are, so that when you're talking to your investors, you are already aware of your existing relationships, your past conversations, and again, going back to Alex's point, if they're looking to say no, you don't want to give them a reason, right? You want to go into the meeting knowing fully well about them and your existing relationship with them. Another example of being strategic in this way will be identifying the right investors. Right? So you have all this data and you have all this information about your investors. If you're in fundraising mode, you can now go in and leverage this information. So I can go and say that for this particular fund, show me all my investors who have invested or who have expressed an interest in investing in a certain strategy. And so I can go in there, I can say, well, show me anyone who, let's say, if I'm looking at a debt investment. So I can say, show me anyone who has kind of expressed interest in these strategies. And all the information that I've collected now I can put to good use, because it allows me to go through this list, allows me to select them, and now these become the target investors that I would be reaching out for my new fund. Okay, so these are some examples of tools and techniques that are available to kind of support some of the themes that Alex was covering. With that, I will turn it back to Alex. Alex,
Great,
back to you.
thanks, Caden. Yep. Thank you, Caden. Appreciate it. So it's always a great overview to see some of the interesting tools and things, and I still have to get back with you guys and pick up some of those for my own use. I think there's a lot of interesting things that Navatar does, and it's kind of as you build out your own process and how you're working with things to figure out what you want it to do, and it's much more usable than Excel, to be sure. Even Excel is a army knife of finance. So to kind of wrap up on the four kind of myths and things that we talked about, and then we'll turn it over to Alan to run the Q&A session. There's lots of difficult things and a lot of hard stuff that we have to work through, but the good news is it's all doable. We all raise funds, stuff gets done, and we all plow forward, and so you just got to keep working on it. But you do have to just keep the kind of simple truths close to heart. You got to know your message, you need to know your audience, and you have to make those match. You got to talk to the right people, make sure that you're not just kind of talking to dead air and talking to people who can make a decision, who can help move the ball forward. And you have to talk to them a lot. It takes, it's a lot more than 29 contacts in my experience, but convenient and clever kind of a name for a rule, so Rule 29, but the fact is it takes a lot of conversations, it takes a lot of interactions, it takes a lot of touch points, and you have to keep track of all of it. You have to keep track of who you're talking to, what you've said to them, what they need next, what the next step is, how do you keep moving the process forward, how do you keep qualifying everybody up or out, and figure out who do you concentrate on and who do you work with. And information becomes critical. It is the name of the game here. You have to know everything that you've done and everything that you've said and figure out what it is you're going to say. But it is fun. It keeps us all busy, and I think so it gets me up in the morning anyway, and sometimes keeps me up at night. But it's what we do. So with that, I'm going to turn it back over to Alan to go through some of the questions. I know collects them as he goes along, and so hopefully he's picked out some good ones for us.
All right, thanks, Alex. So everyone on your right, you'll see the GoToWebinar panel. Go ahead and enter your questions there, and we'll have Alex answer them for you. But I get to ask the first question. Alex, what are you seeing regarding fundraising outside the United States right now? I know you've done quite some traveling.
Yeah, it's every region in the world is different, which is kind of an obvious thing to say, but I think more so now in a lot of ways than it has been in the past. If you look at Europe in particular, if you have a presence in Europe already, and if you're kind of fully embedded with the ESMA, then it's kind of business as usual to a large extent. If you're not already there, if you don't have, if you're not AIFMD registered and compliant, then it becomes a little bit more difficult. I think we look at Europe to a very large extent as being closed to us from an active kind of marketing standpoint, because we're not, we're not registered, we're not planning on jumping through all those hoops at this point, but we are, still somewhat active in Europe and keeping an eye on things, because you do have kind of the guidance of reverse solicitation. You do have people who can reach out to you and can find you, and so it's a fine balance, I think, trying to figure out how do you get in front of people without making it obvious that you're trying to get out in front of people. That said, a lot of the large investors I know, keep their boilerplate emails handy to reach out and say, I'm reaching out to you, and this is not based on any of your outreach to me. And so you can use that as kind of your reverse solicitation defense. I think the thing that scares me most about AIFMD is that nobody's tested any of it yet, and so there haven't been any good cases to kind of provide guidance. So if anybody wants to volunteer to be the first one to be accused of crossing the line somewhere, then I'm happy to see the results, but I don't want to be that person. Looking around other parts of the world, I think Japan is an area that's becoming extremely interesting relatively rapidly, as the Government Investment Pension Fund, or GPIF rather, starts to do private equity. The rest of the Japanese pension funds are going to have to do the same thing. The GPIF is the benchmark, and so everybody has to kind of match their performance. If they have private equity in their portfolio, everyone else is going to have to do it too. I think, as for scale, GPIF is probably on par with the U.S. thrift as kind of the largest pool of pension money, and neither one of them have done private equity. I don't think the U.S. is going to do it anytime real soon, but as the Japanese kind of build out that capability and start to invest, there's going to be a wave of capital coming out of Japan looking for a place to invest. I'm sure there's a wave of marketing going on, going into Japan already. There are a lot of people who have established offices there, but it's going to be a massive draw sometime in the relatively near future, I think. Korea continues to be attractive and interesting, but there are a lot of kind of structuring and regulatory issues you have to think about when you're operating in Korea, whether it's having a broker or setting up feeder funds and getting the bank approvals and all that fun kind of stuff. But it is a relatively active market if you can get all your structures put together. China is still continues to be China, I think. You have very large pools of capital there who know that they are very large pools of capital, and so if you can absorb a $300 or $500 million check, then that's good. If you can do that and keep full control over your firm, then it's even better. I think when the last kind of active area that's a little bit of a frontier, I guess, is South America, as some of the pension funds continue to invest outside of their own countries. Chile and Peru are probably two of the more active ones. It's interesting in South America because you have a lot of family offices that have led the way, and so as the influence of those very wealthy families gets exerted around the country, some of the pension plans are starting to notice that they have other opportunities and other ways to find returns, and so those are starting to open up. Brazil was shaky last week, and it's not a place I would go try to long-term, particularly public money for the time being. So I think we'll let Brazil continue to be Brazil for a while. So I think at the end of the day, there are a bunch of different regions of the world, and they're all active in their own ways. They're all doing their own kinds of things, and so if you can find a niche, if you can find a way in, if you can find a message and a sale that works, then go for it. It's worth it. But you have to know what you're doing. You have to know that you are dedicating resources and time and effort into a particular geography, and different geographies take different amounts of time, different amounts of kind of regulatory hurdles, and different amounts of headaches. But there is capital moving around, and there's a need for returns. The world's your oyster.
I just took a note, a tsunami of capital coming out of Japan. So everyone on the right, don't forget you can ask your questions of Alex on the GoToWebinar panel, and we have one from someone else named Alex. In your opinion, is it more effective to reach out to potential LPs directly versus being introduced by a paid intermediary? So I guess that's the placement agent question, right?
Right. That is a big question. I think it's a little bit of both. It depends on who it is, and it depends on not only the prospect but also the agent. I would say that in my experience, agents have not been panacea. They don't solve all problems. There are places where they're useful. There are other places where they're forbidden. A lot of public plans in the U.S. in particular shy away from talking to placement agents. They have, there are some states that have laws against it. But I think in general, there's a little bit of a feeling against placement agents from the public plans. But on some of the like the corporates, some of the smaller insurance companies, and some of the kind of interesting niche investors, sometimes it's the only way to get through to them, to get them to actually respond to you. Where we have seen success lately with agents is having a few on kind of a, we call it a stringer model, where we're not paying retainers, but they know our firm and they know us well enough to talk about the products and talk about the funds and things that we're doing and things that we're looking at with people that they have particularly good relationships with. I mean, placement agents are good at saying, we have these 6 things, what are you interested in? Or getting into people's heads and figuring out what it is they're looking at and saying, well, I just happen to have somebody that you ought to talk to for that. And so to the extent that you can use a placement agent for those kinds of introductions, it can be helpful. That said, you can get to anybody eventually if you work hard enough at it and you can kind of find a way in and find the right people. But agents can make it easier to get to certain groups of people if you can find a good agent who does the kinds of things you need them to. But I think at the end of the day, you still have to have that long relationship. They need to know you pretty well. They need to be able to, kind of at the drop of a hat, talk about your firm and your products and what it is that you're working on. So, if they're more a member of your team than they are, just a pure paid agent, then they can be a lot more effective that way. Like I said, you can get through to anybody if you try hard enough.
Great. We've got a lot of placement agent clients, so glad that you don't hate placement agents. We've got a question from Steve about co-investing, and I'll read into that question. Is co-investing becoming more popular, or more LPs seeking co-investment?
I would say yes to both of those. We have a pretty big co-investment practice ourselves, both for our separate accounts and on the kind of commingled fund side. So we spend a lot of time doing co-investing. It is interesting as you see a lot of investors looking at co-investment as a way to kind of reduce fees, which is a valid reason to look at it and a good way to go. I mean, it makes sense if you can put $1 into a fund and $1 into co-investments, and you effectively cut your fees in half, and that's a good thing for everybody, the investors anyway. The trouble is that it's really tough to do. It's tough to kind of prosecute deals and actually get things done. GPs are working on very short timelines. There's a lot of kind of information that needs to be processed. There's a lot of kind of work that has to be done, and the difference between doing diligence on a fund and doing diligence on a deal is huge. It's not particularly complementary skill sets. So I think as more LPs are interested in doing co-investment, an unfortunate side effect is that more GPs are going to get frustrated with LPs who want to do co-investment. It doesn't take very many times of messing up a process and needing 6 months to do something that's getting done in 4 weeks before GPs just kind of stop asking and stop showing it. So fortunately, we've got 20 years of history with a lot of our GPs doing co-investments with them and spending a lot of time, and so they know us and they know that we're good people and we'll get a deal done. I think a lot of LPs have dreams and want to do it, and it's good for them, and to the extent they can develop the capabilities, then go for it, but it's not easy. It's not something that you can just kind of suddenly decide you want to do and work it out. So it's certainly a popular thing at the moment. We'll see how long it continues to be popular. As more and more research gets done on it, I think it gets better and better defined how it works and how it doesn't work.
We've got a question from Ebru. Could you please elaborate more on the Salesforce tool you use to follow the investors and investments? So I guess that could be you, Alex, or Caden.
Yeah, I can talk a little bit about the what we're doing, and Caden can step in and fill in with all of the myriad things that I'm sure we're not using that we ought to be. At the end of the day, the main use for CRM of any sort ends up being a place to store data and to keep track of information. The advantage that we saw in Navatar over Salesforce as it is out of the box is that it's really structured for private equity. It's a different sales cycle in private equity. It's a longer term deal. It's different moving parts. You don't get kind of step 1, step 2, step 3, step 4. Well, we got to do step 1 and then do modification A and step 4 C and then go back to 2 and then you want to jump to 12 and then you're back to step 9. So having a tool that kind of is malleable and understands the process and the way that private equity works is important. So the flexibility that Navatar has for generating reports, for modifying the kinds of information that you're keeping track of, for turning on parts and turning off parts has been helpful. It is a Swiss Army knife in a lot of ways. With the other part of it is it's a really good Swiss Army knife. It has a lot of tools that do a lot of different things, and at the end of the day, you can modify it to fit your process and the way that your team works or that your own brain works. Get it to do what you need it to do to keep track of the information so that you don't drop the ball anywhere. Caden, I don't know what you'd like to add to that.
You've covered quite a bit, Alex. So the only thing I'll add is kind of the name of the product is Navatar Private Equity. That's the tool that Alex has been Alex and his team has been using, and kind of it is pre-built for the private equity workflow, and then we support our customers in kind of tweaking and changing and modifying things as needed to kind of conform to your specific processes. So again, if you want to kind of learn more, feel free to reach out to Alan, and kind of we can show you the tool in more detail.
Sure, I'd be happy to talk to you about it, of course. And now hedge funds are also out there competing for investments as well, and that's a question that normally comes up in our webinar, so I'll just go ahead and ask you, Alex, are you seeing a lot of competition from hedge funds?
We've seen hedge funds starting to come back a little bit on the illiquid side. I think it's a popular thing to have an illiquid side pocket in hedge funds, kind of 2005 and 6 and 7. I think it bit a lot of hedge funds and became something very painful in kind of the 08, 09 time frame for fairly obvious reasons. But I think you are starting to see a little bit more on the illiquid side from some hedge funds as they're turn and trying to find a little bit of alpha and a little bit of differentiation. What I do think is happening though is it's a little more intelligent money than it was maybe in the past. Hedge funds are kind of thought of in the private equity world, I think, as fast money, and it's useful if you need it, but if you need kind of patient capital and things that stick around. Sorry?
We've got another question that's come in from Frank about the difference between pre-fundraising and marketing or pre-marketing.
Yeah, it's an important little differentiation, I think, because it's kind of how you talk about things. I think when you're doing pre-marketing, you're going out trying to talk to the market, figure out, what's interesting, what are people looking for, making sure that people remember who you are, but you don't have kind of solid plans for a fund, or at least you don't sound like you do. We just closed our funds. We're not, fundraising right now. We're not doing anything in particular. We just want to see what you're working on and be friends. And it's when you kind of get to the point where you've got terms and you can talk about that next fund, and when you're going to launch it and when you're going to be out in the market with it. That's when you're kind of pre-fundraising, and it's potentially a fine distinction, but I think it's important that it's a different set of language and a different set of tools that you use to discuss with prospects, and then you get to actual fundraising. That's when you have your PPM and your documents. So you want to tailor your message to what it is that you're trying to accomplish, whether you're pre-marketing and just talking to people about things that are interesting, or if you're pre-fundraising and you're talking about what you're planning on coming to market with specifically, and then when you get to actual fundraising, it's a whole other kind of set of words and languages that you use.
Okay. Let's see, a couple of more questions up here. Kevin B. says, apologies that I could only join late. How do we access the recording of the session after the call? And I believe Cindy Chow of Navatar Marketing and Anurag Rastogi are going to be sending out a mailing that will include a link to this webinar. John's asking some follow-up questions about Navatar, and that we're coming to kind of the end of this session. So if you have questions about performance equity, you'll see up on that slide Alex's contact information. Obviously, if you have questions about Navatar, please feel free to call me. My number's right up there, or reach out to me via email. So we are out of time. I want to thank Alex Rogers of Performance Equity and Ketan Kantar of Navatar and Cindy Chow of Navatar Marketing for setting up this webinar. Again, if you have any feedback, if you want to know about Navatar, if you want to know about performance equity, please feel free to reach out to us and we'll get right back to you. Thank you all and have a great day.